Welcome, everybody. Thank you for joining us today. I'm joined by Nicky Larkin of Succession Planning and also Managing Director of Goringe Accountants. Hi, Nicky.
Hi, good to be with you, Stuart.
Thank you. Yeah, nice to speak to you. Um, Today, we are going to look at some of the nuances around valuing and preparing professional services firms for market. Market being either a sale, a merger, a venture, or indeed a fundraise. Now, um, if you look at the financial or corporate finance based press, uh, from the Financial Times all the way through to various industry sectors, you'll see that professional services firms currently are very attractive for the likes of VC and private equity. So um, certainly my time at Clark's as a corporate partner, we have had the delight of acting for a number of professional services firms in property, in finance, accountancy, um, to exit. And out of that experience, there's a number of um, issues or identifiables that are quite unique to the nature of those types of firm. And I guess the most important really is valuation. Um, and Nicky will be better placed than I, but certainly when you are looking at forming a value for your professional services business, what we call reoccurring income, or gross reoccurring income, turnover, if you like, um, gross profits are very important numbers. And Nicky, do you want to add your experience of GRFs and revenue valuations and professional services firms?
Of course, Stuart. So, one of the reasons why they're so attractive is because they are simple to understand. And that's why investors particularly like them. It's very simple for them to see that when they bolt on multiple professional services firms together, they straight away will get a higher multiple. So, what we're talking about there is there's usually two ways to value a professional services firm. Uh, for high end ones, or it often is multiples of the gross recurring fees or the revenues, but also in, say, for example, the accounting sector, of the larger firms. It's on a multiple of the adjusted EBITDAs, which is just a fancy different type of profit calculation. So it's if I give you a straightforward example so you can see why investors like them, is take a typical mid-size accountancy firm. You might get, for example, a 5 times adjusted EBITDA calculation for your sale. So you're taking, a firm perhaps that's got £500,000 adjusted EBITDA. Very simple. That's essentially times 5, you get £2.5 million valuation. As soon as a larger practice buys it, from their perspective in their valuation model, that 2.5 overnight becomes a bigger figure to them. Um, so so the way I've seen many larger businesses, larger firms, they will be in their valuation models be using perhaps a 10 or 12 multiple. So overnight, from their perspective, they bought something for 2.5, but they know that to their business, by adding it on, they're essentially increasing their worth of their business by perhaps 5 million. So that's why there's so much activity in this area, because it's so easy for them to understand, and they think they've created extra value overnight. Does that make sense, Stuart?
Yeah, yes, it does, and I think I would just add that as you touched on there, that the key issue here is that when there is acquisition in the professional services sphere, It is about harmonising economies of scale, really, and therefore um, taking that gross revenue, adding it to another business, the increase in net profitability, which is ultimately generated by savings and economies of scale, is how the uh, the buyer or the investor maximizes their return on that investment. And of course, pivotal to that, which is a nice link moving into the sort of second part of this podcast that we want to talk about, is the importance of staff. Um, in our previous podcast, we talked about technology businesses and the nuances around uh, core value there, and ultimately that being linked to the intellectual property, the stuff, the thing, the systems that are created um, by the business. In professional services spheres, be it property, accountancy, legal, um, what is inherently linked to the gross recurring fees and income is the fee earners and staff in the business, because those staff ultimately are pivotal to the delivery of the the work in progress, and also um, fundamental to the relationships that that business has with its key suppliers and also its key clients. And when looking to calculate value or exploit that value, thought and consideration has to be given to successfully integrating those team members and cultures into the buyer to maximize the um, most out of the acquisition or investment. Nicky, I'm not sure if you could give our listeners some practical ideas on what you've seen in terms of incentivizations or motivations financially or otherwise to individuals or sellers, that so as to preserve those relationships and settle the key fee earners.
Absolutely. So that is the wise buyers will be understanding that those key people in those professional services businesses are the key to the stickability of the clients. So there's various different ways that I've seen preserving them is either, for example, giving them the key players, identifying them straight away and trying to tie them in with different option schemes. Um, uh, Sometimes even given some golden bonuses. Uh, it is a mixture of things. It's about the smart businesses will be looking at talking to them early, understanding what they need to ensure that they stay. Because as we know on the contra, a huge amount of acquisitions do fail, and it's the neglect of these sorts of things that end up making them fail. If you have a sudden exit of a lot of people that you didn't want to leave, because sometimes you do want some people to leave in these purchases. But if what you do, as Stuart said, you want to tie them in. So whether it's on a really attractive bonus scheme, it could be if they're shareholders in the prior business, they might be, junior partners. It's tying them in for an earn out to try and make sure that they're staying for quite a while. Um, but you've got to really try and value that. And remember, it's not just about money. These are professional people. That yes, money is important, but they've got to make sure it's a good environment. Because I have seen some people where it's been a toxic environment they've gone to, however much money that they're stepping away from, they will still step away. So you need to make sure you've got the right culture for them coming into, and also having some really great incentives to keep them to get them to stay.
Oh, thank you, Nikki. I think that that's really important, and we could spend a lot of time um, exploring the concept of change management, and how um, change is naturally perceived in a negative by people, and but I think it's important to note that wherever there's change within the business, specifically around professional services firms looking to merge or looking to seek investment or looking to exit, the founders really do have to think about how that cultural shift and that perception will be considered by staff and other stakeholders in order to maximize the value of the business, or certainly the earnout or deferred element of the um, sale consideration. Well, thank you, Nikki. Thank you again for giving up your time and talking to me today um, on the topic of professional services firms exit and increasing value. To our listeners, thank you as well. Thank you for joining us. Do hope you have found this of interest. As ever, if you do have any questions or queries from Nikki or I, please don't hesitate to reach out and contact us, or indeed, you have any ideas for other topics that you might want to listen to. We are always open to new ideas and views of our listeners. So thank you again, Nikki, and look forward to speaking with you again at a later date on yet another topic around maximizing value, exiting businesses, and specific sectors. Thank you, Nikki.
Thank you.